Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday, all. And it is January 10th. We got the big week today, and that our big day today for the week, and that is the jobs data that we've been kind of waiting for this week. So let's jump into it. We'll look at the non-farm payrolls, and this is brought to you by the Bureau of Labor Statistics, or BLS. We had some revisions actually. So the previous 2 months, November and October, revised lower by 14,000. So the previous month, November here, was at 266. It was revised lower by to 256, and the other month was revised by 4,000. So forecast come for about 156,000 for the month of December, and it came in a little light at 145,000. This is on the heels of what we saw from the ADP on Wednesday that had 202,000. So expectations were pretty high here for jobs data here, and of course, it's coming a little bit disappointing here for investors here. On the unemployment rate, we basically came in at remain unchanged at 3.5%, which is a good sign that the rate didn't tick upwards. However, on the average hourly earnings for the month of December, in November we saw 0.3% uptick, and we thought it would be the same thing for December. However, it only came in a little disappointing at 0.1%. What we're seeing is that people are making on a weekly or less. We're starting to see that trend now. So I think what you're going to see is that you may have had with these, especially with the salary or these minimum wages going up, people are working less hours and then therefore making less money as a result. So maybe their salary might be increasing, but if they're on a hourly, they're working less hours. And but overall, we're looking at weekly earnings. That's also shrinking. That's a much greater shrinkage. That was like dropped from like 3.1 to like 2.1 or something like that. Pretty big drop on a weekly basis. So that's something we definitely want to watch. What we're seeing is that when we have that type of numbers, it's primarily due to corporations trying to cut back instead of laying people off. They're trying to skim back by working people less or working less hours to try to save money, so they don't have to lay people off. And we may be starting to see those beginning stages of that. So again, we'll watch that going forward, see if that improves or not later on. But right now, stocks are up. There's not much on the geopolitical news. They seem to uh, settled down a little bit in the Middle East, so that's not as much of a factor. We got the China trade agreement coming in next week, so the group from China will be coming in on Monday, and they expect to get that signed next week. That'll be the first phase. We still don't know all the details of it or how much of a benefit it is. The market really improved based on that, but again, we don't know how much of a factor that's going to play into helping the economy or not. And also, of course, they're going to be working on phase two, and we'll hopefully learn about how many phases they want to do. If it'll be just a two-phase one, or if there's going to be multiple phases as we try to wrap up any agreement with China. Let's kind of move on here to see how this has affected the bond market. The bond market rebounded yesterday. We had a nice little day. So if you remember yesterday, we were way down here below this Fibonacci level here. We even touched the next level down, which was the 100-day moving average, and worked our way up. So basically, we ended up up, end up ahead. We closed up, I think, 19 basis points. So basically, where we started the day before. So again, that was a kind of a nice move. We had a nice price improvement, and then today we're kind of working our way upwards as well. We're up currently about 5 basis points from yesterday's number. So from compared to yesterday's pricing, yesterday morning, pricing would be better today. This kind of happened later in the day, so it's possible some lenders did not price in for the better yesterday. So you may see that today. So pricing should be better today in terms of mortgage rates, which is a good sign here for where we are. Now, the cautious is we're kind of at that level where we've been kind of at where things kind of get turned away. We haven't really touched this next level yet. So we're starting to get that tipping point. So just be a little cautious being at this level where we could see some downfall a little bit as well. All right. So on the yields, we're down to about, as you can see here, down to about 1.83, I think it is, or 8.84 range here. We're testing the 50-day moving average, and yields have kind of come down a little bit as well. All right, so that's pretty much the wrap for the day. Hope you guys enjoy your weekend. If you guys are in California, you guys are in the market to either refinance or look to buy, I'd love to be able to speak with you. I am a loan officer, work with a lender, and we have a lot of programs. We've helped out many different people in different scenarios, from self-employed people to like with the bank statement loan programs to investors, helping investors products. We got some really unique products for real estate investors. We got programs for first-time home buyers, people who want to move up or down. So we got a lot of different things out there, and can help you guys out. So again, please feel free to please reach out. You can direct message me, or you can go ahead and email me. Email will be the fastest response time, as I get that as I receive that information sooner. All right, folks, you guys enjoy your weekend, and we'll see you guys on Monday. Thanks for watching. Bye bye.